Before we start, I think you really ought to pat yourself on the back for how far we've gotten through this series of videos. As it relates to income tax accounting, there are just a few more additional topics that go beyond what we've covered thus far and are important to give you a global vision of this financial accounting and taxation environment. We've got this 4-step process for recording income tax expense. You've either memorized it by now or you will in short order. What's convenient is that this process is identical for the accounting for both deferred tax liabilities as well as deferred tax assets. So, as long as you can correctly identify the temporary differences that stem from a transaction and properly classify them as resulting in either a DTA or DTL, the rest of the accounting is pretty formulaic and easy. At least that's the case for the initial part of this accounting, but it turns out that deferred tax assets come with some additional considerations that we now need to discuss. Let's take a quick step back and remember what these two deferred tax accounts reflect. First, let's recall that deferred tax liabilities reflect future taxable amounts. In other words, relative to my book income today, I'm paying fewer taxes, but in some future period, I'm going to be paying more. Deferred tax assets, on the other hand, reflect future deductible amounts, or cases where I've paid more in taxes today relative to what my book income would have otherwise suggested, but in some future period, my taxable income will be lower than my book income. At first pass, it seems like there's a whole lot of symmetry behind how we account for these transactions, but it turns out that the certainty of future outcomes and their relevance to financial statement users is not the same. The temporary differences attributable to deferred tax liabilities, they're going to naturally reverse with time. But with deferred tax assets, there are going to be a variety of scenarios where future reductions to taxable income are frankly less valuable. So let's talk about these reasons. First, you can only benefit from deductions when you have positive taxable income that you're trying to offset. But what if you don't actually generate future profits? So certainly for startup companies or those in financial distress, we really don't want to consider future deductions to income as an asset to the company. More broadly, this doesn't just reflect the overall income of a consolidated entity. I'm also talking about the fact that many companies have subsidiaries or other divisions that operate in a variety of tax jurisdictions, generating profits and losses in different areas of the world. Take Disney, for example. They've got profitable operations in the US for streaming subscriptions and domestic theme parks, and they probably have relatively smaller foreign subsidiaries that are reporting accumulated losses. If Disney's management determines that it's unlikely for that foreign subsidiary to generate taxable income in the future, then temporary differences giving rise to future deductions, they're not going to be all that valuable for that part of the company. Second, certain tax benefits may come with limitations, including expiration dates. Again, I want you to consider that companies operate across state lines and international borders, so a full understanding of the value of deferred tax assets presupposes a familiarity with tax law in all the jurisdictions where a company operates. Maybe some tax credits have limits, or companies are required to make use of a tax benefit within a certain time period. In any of these cases, companies are required to record a valuation allowance, a contra asset account directly tied with DTAs, to the extent that it is more likely than not that the tax benefits associated with that DTA will not be realized. And just like any other allowance account that we worked with this semester, when you record a valuation allowance, it's going to decrease the net amount of that deferred tax asset presented on the balance sheet. And as a contra asset, as you increase that account with credits, the counterpart to that journal entry is going to be additional income tax expense on the debit side. Related to this is the topic of uncertain tax positions. I want to start out by clarifying that We expect most companies are working to legitimately reduce their overall tax burden. I'm not considering super overly aggressive tax planning or even illegal activity. What I'm truly referring to here is the idea that taxation, like financial accounting, is not always a black and white situation, and considerable judgment is involved when the correct tax treatment is not entirely clear. Examples might include whether a deduction is allowed, whether certain income is taxable in a particular jurisdiction, or whether the company qualifies for a particular tax credit. For financial accounting purposes, we acknowledge this complexity, and we have to determine the extent to which the positions taken on the tax return are going to withstand legal scrutiny. Under ASC 740, Accounting for Income Taxes, management has to evaluate whether it's more likely than not that tax positions will be sustained if authorities challenge them. And where a certain position does not meet that threshold, the company cannot recognize that tax benefit in the financial statements. In other words, the associated income tax expense must still be recorded, but instead of crediting taxes payable, it's going to be a separate liability account called an uncertain tax benefit, or UTB. Taxes payable reflect the size of the check you're going to send the IRS. Separately presenting UTBs gives financial statement users additional information about tax benefits the company has claimed, but that may not ultimately be sustained. And finally, the last of all these additional topics relates to the concept of permanent differences. Up until now, all of the book tax differences that we have considered have been temporary in nature. They originate in one period, but ultimately reverse with time. Permanent differences reflect areas where financial reporting and taxation never see eye to eye. Specifically, I'm talking about income that's appropriately recorded as such on the income statement, but is never taxable. Or on the other side, various costs that are appropriately expensed for financial reporting cannot be fully deducted on the tax return and never will be. And we have some important common examples of these. We'll discuss the why behind these later, but for now, I just want you to think in the back of your head, what is the government trying to incentivize or discourage for each of these items? We first got the interest that a company receives from bonds of state and local governments, which is generally not taxable. Then we've got cash flows relating to life insurance for a company's executives. Suppose the CEO of a company unexpectedly passes away. Then the proceeds the company receives from the insurance company are not taxable. On the flip side, all the premiums that they'd been paying up until that point could not be deducted on the tax return. Next, we've got meals and entertainment expenses, which I think many sales managers view as a legitimate cost of doing business. You've got to wine and dine certain clients to gain or retain their business. The expenses relating to business meals are only deductible up to 50% of the total cost spent, and any expenses relating to entertainment are not deductible. Lastly, losses due to goodwill impairment are not deductible, nor are fines and penalties in association with breaking the law, which I think makes sense, right? So, all of these types of events reflect permanent differences that will never reverse in the future. And they have nothing to do with deferred tax assets or liabilities because while they might affect the company's effective tax rate today, there are no implications for future taxes.